Wow, guys, another day, another huge market move. What went up must come down after the largest trade ever recorded was found by us as a community. But what does this mean moving forward as markets have sold off 50% of their gains? Well, in today's video, we take a look at what's happening with volatility, the data surrounding what tends to happen next, whether there's a good case for bulls actually right now, and of course, where are markets going for safe havens in times where bonds continue to freak out. Yes, we've got some big updates, we've got some amazing data, and we've got dark pools coming your way. Let's get into what Wall Street has been up to over the last 24 hours. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. We'll go through the big data, the macro storyline, what Wall Street's been up to, which is very sneaky, and of course, look at the key levels and options flow that we need to look at. If it's your first time here, make sure to subscribe if you love markets like we do. We're covering them every single day with the information that you need to know right now. Speaking of that, what just happened? 9.5% up, the number one largest trade we've ever seen on the SPY. And of course, that was a sell. Most of you guessed it correctly in the comments yesterday, and I'm sure it was relatively helpful. But let's go through what this means moving forward. When you tend to see a 5% gain, as you can see here, Ryan Detrick has found that since the 1950s, that doesn't necessarily mean that the next couple of sessions are going to be that easy. In fact, volatility is usually here to stay, and it only tends to do better after a long period of time. 12 months later, okay, a lot are decent, but there are still all sorts of sell-offs that can occur. And we saw this when we looked at the outlier points. Mark here has found all 9% plus days since 1955. As you'll see in a moment, if you go back even further, it gets very interesting. And you will note that they are during periods of incredible gains and losses. And you might be thinking first up, oh, well, that looks like it just keeps selling off. Actually, these are gains and losses that happen so quickly that by the end of these weeks, oftentimes the markets have reversed everything they've put on. So are we heading for that again? Well, let's take a look back into the 1920s during, of course, what is well known as being the roaring 20s and the depression that started after that in the stock market, the lost decade plus that was due to so many things. And the only times that we really see markets that are this volatile are during those types of times. The really heavy sells of the 1930s, and of course, some of the most notable sells over the last 30 plus years. And thanks to quantifiable edges here, we can see that when we look through at the next few days, and specifically even the next 10 days, things get pretty gnarly. And what is going to counteract this is, of course, going to be the tax cuts and everything that's now on the table. Now, the House just passed the initial tax cuts for everything that's been going on, and obviously the market is sniffing that out and liking it. And that is, of course, one of the bullish catalysts. As you'll see in a moment, there is another bullish catalyst that, if enabled, could be an incredible one for bulls out there. It's one of the rarest, one of the best, and in today's video, we'll talk about it. One of the most volatile weeks in history. Yes, we've witnessed history, we've been through it, and we're now going to call this locked in stone, most likely, the tariff trade war, which obviously means that we are now part of that. Now, most of us probably don't want to be part of this type of history because it's very, very wild, but it is something that you often do look back at in your trading and investing career and say, I was there during that point. I always encourage people to remember how this feels, to remember this volatility. And although you may say, I don't want to, it's because of risk management. And remember, this is the type of thing that can happen in markets during any point in time. Sometimes crises do appear. Average true range, you can see here, hit the 6% threshold, taking us to a very rare point in history. But what does all of this mean? Well, it basically means uncertainty has exploded and people are worrying across the board. In fact, credit spreads might be going up, but take a look here when you look at US CEO confidence. We shared this over on our X account, links in the description down below. Basically, it exploded out of the gates, and this is showing that we are probably going to lose buybacks, which means that $1 trillion of usually pumping into the market is most likely gone this year. And I wouldn't be surprised if that goes to $250 billion. The last time I saw it recorded, it was down to a third of the $1 trillion. We're also going to see potentially firings, that is unemployment, spike back up. And we'll talk about that more later on today's video. But the next question becomes, is it time to buy the dip? About 2 or 3 videos ago and during our Monday live stream, we talked about how there was correlation across the board. Basically, the market had become so oversold, we saw a small structure, and we formed a base. And now we're trading within 2 key levels, a heavy supply resistance and a heavy demand support. Now we're at about 18 times multiples, which historically has not been the lowing point. And as you can see here, based on this chart from Markets and Mayhem, that usually we tend to go to lower multiples across the board if we are in a fully fledged sell. Now, as we know, snap of our fingers, a lot of this could be taken away if tariff wars de-escalate. So of course, that's going to be an important factor. But another important factor is going to be whether we see enough good news in this market. Now, some of you are probably aware of Zweig breadth trusts. We've used them several times. We used them back in 2023 and in 2024 to be very accurate, of course, with some very nice bull runs. Now, people are going to be looking for this again. And as you can see here from Grant Hawkridge, we do have the possibility of a Zweig breadth thrust in play. Now, we'll have to track this over the next 10 days. So obviously, depending on volatility, we'll be checking it out. But for the bulls, this is certainly one that you cannot miss. And if this does happen, it's a very good sign. They tend to be quite accurate in terms of bulls and bear moves. Now, it's too early to call it, though. Of course, they break all the time and don't end up activating. Speaking of things that did activate, we saw the largest trade ever. And I want to say a big thank you to you guys for liking the video, sharing it, commenting, everything like that. Absolutely, amazing stuff. I really appreciate it. We put this stuff together to help you. You obviously enjoyed that video, so we do like and say thank you very much for that. Now, biggest ever, that was a huge one. It was everywhere. There were queues, there was SPY, there were so many trades. And after a 9.5% gain coming back into resistance, we were always going to see weakness. From that point, of course, we've seen delisting rumors. We've seen tax cut, potentially starting to come through. And obviously, I believe higher tariffs potentially on China. So again, I didn't confirm that, but yeah, these numbers are so high now that I'm sure that the market's not even looking at those. They're thinking, well, something will be done. Number one trade means that somebody most likely sold up here as the price action obviously reversed. But this will now become a great line in the sand for resistance and a key level for us to watch in the future. And one thing we didn't mention in the previous video, but I think it was pretty clear with everything else, is we also had the second largest trade ever on the queues. Now, of course, that's a big deal. Markets actually sold from that. Okay, cool. But take a look at this. Old sneaky dark pools came out of nowhere near the end. The third largest trade ever, now a dark pool, and the sixth largest trade ever. These are just mammoth single positions, and they're coming through all over the place. Could that have been a buy at the 50% dip from the markets? It certainly could be, and that may be a positive for price action along with markets getting excited about a tax cut coming. We also had some other sells that came in during the session. It turns out that Amazon had a big one on the resistance, and again, the markets pulled back 50%. So what are we in? We're in a game of, as I said in the previous video, chicken and mouse, but really, of course, it's cat and mouse. And as you guys know here, it comes back to earnings, it comes back to guidance, it comes back to getting these tariffs paused or reduced, and the market feeling good about itself. Remember, markets will go up on a wall of worry. So although volatility and the stats are still pointing towards the possibility of another low, you've got to remember that it's not easy to pick a totally good bull run rally because oftentimes it will go up when news is still pretty bad. Now, we do have huge earnings coming. And as you guys know, especially the earnings on the tech companies are going to matter. So pencil in Thursday, the 17th of April. That's going to be a huge day. We'll be following it. We'll be showing you the implied volatility coming into it so you can see what the options market is pricing. So much to go into. I'm very excited to bring you this earnings season, some good stuff coming on this channel. But let's go back to why we still are a little bit cautious here. You might think that was a great day, 10% up. Again, historically, not the best. You'd be surprised. Oftentimes, volatility is here to stay. 2 weeks later, again from Subu Trade here, only 44% of the time a market's up. So if you did buy the dip, should you be happy about it? Well, traditionally, when we saw this on Monday, which was 0 stocks in the technology sector actually above their 50-day EMAs, that was not a really good sign for the bears because, of course, that is an incredible oversell. Now, traditionally, this has been close to bottoms, but I want to just go back and point out 2018. While we did hit 0 and bounced around for a bit, we still ended up making a new low. We did so as well in 2015, and we did so as well in 2011. What it marks is a very important point of structural base. And oftentimes these are fairly good levels for the market, but it doesn't discount that we could be going towards 4,700. That's actually a very important zone to look at. Weekly 200, very important zone. Certainly worthwhile putting on your charts. We'll talk about it soon. CBOE, S&P volatility. Obviously, when vol gets this high, you're in unprecedented times. We don't see too many of these. Again, the vol here of the global financial crisis and the COVID crisis, as you can see over here, a lot of up, down, all around days that were, within those vicinities, 7%, 8%, big movements across the board. Now, why is all of this important? Well, it brings us up to the question of when we enter into a technical bear market, which we did over the last week and a half, then are we in ones that are soft landings or hard landings? Now, I'm going to do a poll soon of the community to see what you guys think. Traditionally, of course, the stats are in the hard landing favor. That is, there are way more chances that a recession is coming. Obviously, JP Morgan, Goldman Sachs, they're between 40 and 60% chance, but who's really paying attention to those numbers? The reality is that soft landings are rarer and they're going to need some good cases. And in this case, of course, we're going to need those tax cuts. We're going to need deregulation. We're going to need the Fed's QE to get us out of this tariff stuff. I think that's pretty much the only way to move forward with this market. Earnings are going to show probably okay earnings, but I bet you most of these companies are going to be like, oh, no forward guidance, guys. We don't have forward guidance. We can't figure out what's going on. Uncertainty is the horror show on markets. Of course, markets absolutely hate that. So when we've had the VIX at 45 for 3 days straight, as you guys know, the vol is usually still here to come. These are the stats surrounding that. And as we already have gone through many, many times over, we'll be tracking basically planned job cuts. We need to look in front. Remember, job cuts themselves, unemployment numbers are lagging. We need to see what's happening in the real communities. So obviously we don't know that yet, but planned job cuts seem to be on the rise. Smoot-Hawley tariff versus Liberation Day. Markets at the moment are kind of following a similar path. Seen this so far. Oh, not that high. Basically, we've seen this so far. So the question is, do we continue down like this? Because if we do, as you guys know, that's breaking structure. That is not good. So if we do make lower lows, let's say 4,700 or even lower, just be warned that at that key point, we do need to see strong bid buying. We don't want to fall too far under 20 because that traditionally has been a very bad sign for markets across the board. Now, another bad sign is, of course, copper-gold ratio. And while I don't use it much anymore, it used to be one of my main leads. I used to love copper-gold ratio a long time ago. It has dropped off a cliff. Now, that traditionally tells you the US yields will drop over time due to growth concerns. But, of course, at the moment, that has not been the storyline with bonds and obviously treasuries and all sorts of auctions going on, stories about China dumping off. And I just want to kind of reiterate this. China owns a lot of bonds in the US, sure, but I don't worry about that storyline, okay? I know that maybe we'll prove it on the weekend video, so stay tuned for that. But yeah, don't worry about that one too much. They don't own as much as they used to. So that storyline, not liking that. Let's be real. US treasuries are still highly, highly regarded in the world. You don't demolish that just in one day. So yeah, I know Buffett's buying yens and yen treasuries or whatever he's doing, but generally speaking, you've just got to remember that storyline, we'll look at that one on the weekend. You'll see what I mean. Now, how many days have we stayed above 27? Well, VIX has stayed above a lot. And we're now getting in on a week and a bit of this. So we're about to hit 11 days soon. And that, of course, tips us over to the possibility of a year end on markets red. And, of course, the problem is when you lose a quarterly streak of great bullish runs on the S&P, well, you can see what tends to happen. It's slow down. It's sideways, and sometimes it's horror show. So this is the thing that we need to remember. The second quarter, third quarter, first year, while the first quarter can look good, we must be looking at structure in every way, shape, or form. How was the last 24 hours on markets? Well, this is the last 5 days. Semiconductors are now up on 5 days, if you can believe it. And the rest of the market, you really can see the pain in things like oil. And oil getting hit like that really shows that there is a big concern on consumption. And realistically, that is, again, growth. So when oil gets hit this low, you've got to be concerned on growth. Let's now have a look at what's going on when it comes to rotation the last 24 hours. It was actually a defensive move as markets sold off. Semiconductors obviously down 7. So this was a risk off type of session. Since then, we've seen markets a little bit recover, but they're still down 52, 30-ish area. You can see they went as low as the 51s. And what we'll do is we'll overlay here. That was before, of course, the House passed the initial bill by razor-thin margin. And you can see here, obviously now it goes to the next section, but we're getting into that kind of 50% fib. So we basically retraced 50% of what was put on. And this is where you generally expect a market to try to buy back up. Now, I'll show you why, and a lot of it has to do with VWAP. So you've got anchored VWAP kind of coming in here. And you've also got a very decent declining kind of trend line here, which could be taken out. So I think for a lot of traders and investors, they're going to be looking at a 5,400 plus now as a good sign to fill potentially the secondary gap. Now, you must mark your gaps on charts and be aware. If you actually have a look here, the gap fill is at 5670. That also coincides with the most traded zone, which sits around 5600. So where are the bears going to sit? Right in here. If we go bear, like move up here and then go down back under this level, we're going to hit a new low. 4,700 is likely at that point. And the reason why is because if you look at the weekly, and I don't have the weekly 200 on here at the moment, but if you do put a weekly 200, you're going to see that sitting right down in this structure. And this demand here is going to be the one that most people don't see. So that's going to be a very key level as well. So the current game plan for markets is they might like this tax cut. We do have potential of Barber getting delisted and all sorts of things. But just remember the gap fill is at 5670. We have 5600 being the most traded zone. And as you'll see in the moment, there are puts everywhere still. So the markets may wish to not cascade. Now, what we've been witnessing recently is just overwhelming puts. You guys know what I mean. 5,400, as soon as that dropped, absolute waterfall moment. Market just tanked itself all the way into under 5,000. Now we've got sustained puts sitting at 4,900s, at 5,200s, at 5,100s. This is just the 0 DTE, let alone next week. Look at this. This is a weird one, 46, by the way. Just underneath that 47. But yeah, puts everywhere and some calls starting to appear as well. So markets may stabilize. The key here is going to be looking for where you have edge. So do you have that much edge around here? You might be trying to be a buyer based on, breakouts of that little downward trend line and stuff. If you are, I think you can't ignore 5,600, 5,670, that kind of gap fill area. And if, of course, you're a seller, then you're just hoping that we lose structure over the next 24 hours and start pushing down. Again, the odds are in, of course, at this stage. The volatility tends to breed more statistically down sessions than up. But, we live in unprecedented times. NVIDIA, what's going on here? Above 105, actually in positive gamma. So NVIDIA entering into positive gamma again. And Tesla basically at 250. So it's been a bit of a resistance. 262 was the big one yesterday, and that remains that really hard call for the markets to get through. Now let's jump on over to what we've got in the bonds market. The bonds market indicator that I like to use, that one is very uncertain. I wouldn't say there's too much recovery there. As we did see at the beginning of the video, credit spreads have come off a little bit, but they're still incredibly high. Percentage of stocks above 50-day, that's obviously still at very oversold levels, traditionally with more of a downward kind of move, and copper gold is getting tanked. So basically, this is just showing, again, the market is very concerned about growth, and you'll be able to tell that when you look at an oil chart. We'll do that in a moment. In terms of high yield junk as well, worthwhile always paying attention to high yield junk, and you'll see that that is stabilized over the last 24 hours. And yields, which is pretty much probably what really caused a bit of the backflip here, they've regained back to where it is. So it's not like yields, technically you want yields down at the moment is mainly, I think, what's trying to be achieved. And the market is not allowing that. So you can see here, yields, you pretty much have to watch the US 10-year. Warren Buffett often was asked what's his favorite indicator. And his answer, other than his own indicator, the Warren Buffett one, of course, was the US 10Y. And you can see why. The US 10Y this is a very important chart. So we'll keep watching this. Breakouts above 4.5 could shock the market down. So just be careful here. The yields are in action. Now, what about home builders? That lost and destroyed kind of structure a while ago. So obviously it's stabilizing, but this is a bad sign long term for the economy. It could be on the recessionary path. And obviously one of our favorite areas to be in, which is gold, That's absolutely flying. We might actually hit this 3,600, guys. That we remember we had two goals 2 years ago. 3,000, we did it. 3,600 now. Hey, gold is doing well. What I'm guessing though is the gold is actually not savable in a liquidity crisis. So just remember, this seems to be that we are not currently in a liquidity crisis. We are just in a global trade war. So basically, gold is loving that. Of course, stagflation is a possibility. Gold loves that. There were a lot of reasons why we've liked it, and we've talked about it 2 years straight, and it continues to be pretty much the best performer in the market. Silver, the sloth, is two-pronged. It is a currency. It does have some of those capabilities, but it also is a used metal. So it's struggling, but still up and still technically in a turn here on the smaller time frame. So that's worthwhile watching. The other one that I guess you might want to look at is parity on the dollar. Take a look at this. The US dollar got flogged down to parity. So we've been weak on the dollar this year. I suspected that based on the tariffs, based on everything else. I know that's counter logic, but there are reasons why. And this is pretty much the last bull area. So if we start dumping under this, could that be a repeat of what happened in Trump 1.0, which obviously was, some weakness in the dollar, as you can see over here. So we got a lot of weakness in the dollar during that first point. And then you can kind of argue this was the tariff area. So it's going to be interesting. Weakness in the dollar certainly coming through as bonds and money flows and all these things go out of the US. US oil, I would not touch the oil right now. Look at it. You could argue it's trying to form base, but this thing it's big volume, but we're hitting 60 a barrel. That could be support. It overshot. It's super oversold, but yeah, I think it's a very tough trade. I've said that many times. It's a geopolitical trade that is scary. Double bottoming. What's going on here with Tesla? Are we going to enter a double bottom? Again, this could be great structure in the future. We'll be watching 295, 300 key, and it's the same. 220, 200, 250, 280. These are all the key levels. Nothing else really matters too much. Check out those options from before. HSI, this is Chinese market. It's regained a little bit, but obviously delisting rumors and all sorts of things are keeping it down. Great level. No real bid yet, so we'll find out what happens there. Too many very intricate things going on there. And Nvidia, as you can see, no break above the most traded zone, no break above 122. So it's still in a downward trend, as are semiconductors. And I think we need to remember that. Look at this one, the daily 20. Put that on your charts, guys. Look at this. 1, 2, 3. Obviously, we're looking for a turnaround in the future on that one if possible. And the German 40 is the same thing. It came back down. All the markets around the world kind of look like the same thing. Let's have a look at the NASDAQ quickly. NASDAQ went up, daily 20, sold off. No surprise, huge trade. Obviously, that's going to come through. And you can see here, we've got kind of the similar leg pullbacks each time. So I think if you were going with similarities in this market, you would say, well, are these legs about the same? Yes. Okay. Oh, wait, we'll get rid of that one there for a second here, guys. And I like to do this because, a lot of Elliott wave traders do this type of stuff. And then, of course, you can see here that if we take the distance, it's not the same, but it certainly is the same pullback. So if we're going to find buyers around here, makes some sense. Certainly day traders will be looking very carefully at prices. Let's go down to smaller structure here for a second. And what you'll notice, again, is that it's a base, downward trend line. So that could be something that you're looking at here on the small time frames, and I'd probably be looking at around 18.8 to really confirm things. And a lot of people will be looking at scales here and what's going on, but the market is in flux. So remember, you've got to be short, sharp, sweet. Yes, there are good day trades. Yes, there are many risks, and I'm sure we're all aware of that when we see these huge 9.5% sessions. Exciting times and scary times at all. US 2K probably came back to about 61.8 fib golden ratio. And as on top of that, we are at the most traded zone. Very little evidence on the US 2K either way. And of course, if we go over to Bitcoin here, you'll notice that it's put in what we would call a double bottom, gone into the most traded zone. Some day traders are going to be trying to buy around this area, but really a swing trader is going to say we are not out of this until 89,000. So it's still way too early to tell. Again, some maybe signs, daily 20 held down 3 times. When I see at least quite a lot of repetition in the same moving average, I will pay attention to that, and we will update when necessary. To really summarize what's happening at the moment, we could talk about CPI, but what a waste of time. This is all about tariffs right now. 0.1% down, 0.1% on the core. Obviously, food was up. That was the big issue. PPI is coming, but really this is a it's a point in time where all that matters is this tariff discussion and deregulation and tax cuts, and that's really pretty much about it. The weekend is going to be wild. Do remember that we could see upwards of 4 to 5% weekend gaps. This is the type of thing that's possible. Protect yourself out there if you can with whatever you're trying to do in trading and investing, guys. It is a dangerous period, as you know. And on top of all of this, to summarize these markets, I think you've got to play the stats a little bit, and you've got to play where you believe you have some form of edge. So obviously that's going to be based on, recognizing key things. Did we see selling? We suspected over the last 24 hours. Have we seen rebuy-ins? Well, there was that big dark pulling at the end of the day just before we get this announcement by the House. We'll now see whether that's enough to carry us through. And obviously we need de-escalation. That's the key. Thank you so much for watching. We'll see you in the next one. Bye for now.